Hi guys, let's quickly revise Ind AS to inventories. Okay, as we know, this standard is applicable to all inventories except financial instruments and biological assets related to agricultural activity and agricultural produce at the point of harvest. However, agricultural produce after the point of harvest are covered by Ind AS 2 only that we are going to discuss, right? And inventories definitions, as we know, they are assets in the form of finished goods held by the entity for sale in the ordinary course of business, are work in progress in manufacturing process, are raw material to be consumed in production process, are used for providing services. Right? This is inventory definition. Now coming to the core area of the standard, measurement principles. What standard is saying? Inventories shall be measured at lower of cost and net realizable value. In order to conclude this, we need to first calculate the cost. After that, we should estimate the net realizable value. Okay. Thereafter, we can compare. Resultantly, we will get to know which amount is lower. Accordingly, we will account. Right? Let's discuss one by one. Cost of inventories. Cost of inventories includes what? Purchase cost, conversion cost, and other costs incurred to bring the inventory to the present condition and location. Let's discuss this one by one. Cost of purchase of inventories. Purchase cost, purchase price included. Import duties and taxes. Import duties and taxes only if they are non-refundable. If they are refundable in nature, we should not add. Transportation and handling costs, yes, we can add. And other costs that are directly related to purchase of finished goods or raw material, and even for getting any services also, we can add. Trade discounts and rebates and any other similar items, we can reduce. Clear? And coming to the next one, cost of conversion means what? Cost incurred to convert the material into finished goods, and that cost is directly related to our units of production. That also we can add to the cost of inventory. Direct material, direct labor, and other costs, and indirect expenses such as fixed production overheads and variable production overheads that can also be allocated on systematic basis. Variable production overheads directly change with our units of production, correct? So standard is saying that allocate the variable production overheads on actual basis. And coming to the fixed production overheads, I can say fixed cost. Fixed cost remains constant regardless the volume of production, correct? So what the standard is saying that allocate the fixed cost on the basis of either normal capacity or actual production, whichever is higher. For suppose, if our normal capacity is 5 lakh units, our actual output is also 5 lakh units. Allocate on the basis of normal capacity, fixed cost divided by normal capacity. So that per unit value we will get now, you multiply with the actual output. Similarly, if our actual output is 3 lakh units, our normal capacity is 5 lakh units. In this case also, allocate the fixed cost on the basis of normal capacity. What's our fixed cost divided by our normal capacity? How much? 5 lakh units. We will get per unit value. You multiply the 3 lakh output with that per unit value. You will get some amount. And the remaining fixed cost, if any, that you charge to profit and loss account as an expense. For suppose, if our actual output is 7 lakh, normal capacity is 5 lakh. In this case, allocate the fixed cost on the basis of actual output. Fixed cost divided by actual output. You will get the per unit value. Allocate the same to the actual output. So this is what the standard is saying. Clear? And next one is, what is that? Other cost, correct? Yeah, this one, other cost. We discussed cost of purchase and conversion cost. And next one is other cost. Cost incurred to bring the inventory to their present condition and present location. I can say this is a residual category. If that is in directly relation to our present inventory to get the present location in and present condition, we can add it. Standard has given a few illustration examples that we should not add to the cost of inventory. We should charge to profit and loss account. What they are? Abnormal cost, abnormal loss, be it a material cost or labor cost or any other overhead cost. If they are abnormal in nature, you don't add. Charge to profit and loss account as an expense. Storage cost also. Storage cost also recognized in P&L account as an expense. Should not add. However, if that storage process is also integral part of manufacturing process, in that case we can add to the cost of inventory. Let's say example, pickles like mango, tomato, amla, or any other pickles, and in case of wines, whiskey, in that processes, Storage is an integral part of manufacturing process, correct? In that cases, include the storage cost to the cost of inventory. Should not charge to profit and loss account as an expense, right? And next one is administration overheads and selling and distribution overheads charged to profit and loss account as an expense. Borrowing cost. If it is allowed by Ind AS 23 to include to the cost of inventory, include it. Otherwise, charge to profit and loss account as an expense. And next one is if we acquire inventory on deferred settlement terms, deferred settlement terms means what, sir? It is an abnormal credit period. In that case, whatever the consideration we are going to pay to the vendor includes interest cost. So that interest cost we should not add to the cost of inventory. That interest cost should be recognized in profit and loss account as an expense. Clear? So with this, we determined the cost of inventory by adding cost of purchase, cost of conversion, and other costs. Right? Now we know the cost of inventory. So in special cases, how to determine the cost? For example, if our product is harvested agricultural produce, so what is the cost? Let's assume this is point of harvest. So till now, Ind AS 41 applicable, and after this, Ind AS 2 is applicable. Correct? As per Ind AS 41, we measure the harvested agricultural produce at fair value less cost to sell. Once the harvest is completed, it will become inventory, and that should be accounted as per Ind AS 2. At what amount, sir? Fair value less cost to sell only. That fair value less cost to sell becomes cost of that agricultural produce as per Ind AS 2. Clear? And next one is allocation of cost to the main products and byproducts. For suppose, if our manufacturing process results to only main products, in that case, if the cost we have incurred can be separately identifiable for each product, we can take that separate cost. If we cannot identify the cost specific to each product, in that case, allocate that cost on the basis of relative sales value of that main products. Clear? Now, second one. If our manufacturing process results into main products as well as joint products, main products as well as byproducts. In that case, estimate the net realizable value of byproducts because byproducts are usually immaterial in nature. So that NRV reduce from the total cost, that net amount allocate to the main products on the basis of their relative sales value. Clear? If the byproduct is also material, treat it as a main product and allocate the entire cost to the main products and byproducts on the basis of their relative sales value. Clear? So this is all about how to allocate the cost to the joint products and byproducts. Next one is techniques for measurement of cost. It is nothing but cost formula. If the inventory is not ordinarily interchangeable, means what, sir? They are unique, customized. In that case, follow the specific identification method. Means what? Cost specific to that particular inventory can be considered. Okay. And next one is inventory ordinarily interchangeable. It means what? Inventory can be replaced. In first case, inventory cannot be replaced. They are unique. They are customized. They are unique. In this case, inventories can be replaced. Historical cost method we can follow. Historical cost means actual cost. Okay. Non-historical cost method is estimation based methods, I can say. Estimation based methods we can follow only when it results into approximation to the actual cost. Okay. In that case, we can follow. Otherwise, we should not follow. As for historical cost method, FIFO and weighted average methods we can follow. FIFO means what, sir? So whatever the inventory we produced or we purchased first or selling or issued to the next further process first, and remaining inventory any in our godown is most recently purchased or most recently produced material, right? And as per weighted average cost formula, what we do is you take the total cost in the numerator and take the total quantity in the denominator. You will get the per unit cost. So that is the cost per unit at which we can measure our quantity of inventory, right? And coming to the standard cost method, this is a non-historical cost method. It is of course a costing concept. What we do, we determine a predetermined rate called standard rate. When we know the actual cost, we do the variance analysis. That's it. And in case of retail price method, we can call it as a adjusted selling price method also. In this case, what we do is we deduct the gross margin percentage from the sales value. That gross margin should be determined on the basis of the judgment. Okay, and the resultant amount is the cost at which we can measure our inventory. Usually this method is applicable in retail inventory for fast moving inventories. Okay, so this cost formula, the same cost formula shall be applied to the all inventories having similar nature and similar usage. If the inventories are having a different nature and a different usage, in that case we can follow the different cost formula, but we should justify it. Clear? For example, if we are having one segment in Hyderabad and another segment in Bangalore. In Hyderabad segment, we are trading cement bags. In Bangalore segment, we are in construction industry. Here we just purchase the cement bags and sell to the customer. There we purchase the cement bags, we consume that cement bags in our construction projects. Okay, it means what, sir? Nature is same, cement bags, but usage is different. In this case, we can follow the FIFO cost formula in Hyderabad or weighted average cost formula in Bangalore. It means what? Different cost formula can be followed for Hyderabad and Bangalore segments. Okay. Same cost formula also you can follow. It is your choice. Real. And one more. In both segments, our business is only for trading. It is nothing but what's our same nature and same usage. In that case, we should follow the same cost formula, right? So till now, what we have discussed is about determination of cost. Now coming to the next step, that is net realizable value. Net realizable value of finished goods. What we need to take? Firstly, we need to estimate the selling price of finished goods. From that, reduce the selling cost. We will get to know the net realizable value. If it is a work in progress, we may or may not has a market for our work in progress. In that case, same sir. Estimate the selling price of finished goods. From that, reduce the estimated cost to convert the work in progress into finished goods. From that, reduce the selling cost. We will get to know the net realizable value. Net realizable value is our entity specific value. Correct? It is our internal purpose only we are calculating it. Fair value is market related. So fair value less cost to sell and the net realizable value may or may not equal. Clear? And while estimating the net realizable value, we should consider most reliable evidence available at the date of estimation. For suppose, if we have already entered into a contract, if we have already entered into a contract in respect of our inventory, in that case, our contract price, replace the contract price in place of estimated selling price. Okay. If our material is not covered by a contract, in that case, estimate according to, general conditions. Clear? That is what the standard is saying. And one more thing, while estimating the selling price, any event occurred after the reporting period, any event occurred after the reporting period should also be considered. If that event having any condition at the reporting date, at the end of the reporting date, what I'm saying, while estimating the net realizable value, any event that occurred after the reporting period can also be considered if that event is having evidence on the on the end of reporting period. That is what the standard is saying. Example, if our price and demand for our products start declining from 10th March and we sold that inventory on 14th April, let's assume. It means what, sir? Our price and demand of our products start declining before end of reporting period only. So in that case, we can consider that events, right? If our price and demand for the product start declining after the end of reporting period, in that case, we need not consider that. That is what the standard is saying, right? So till now, what we have discussed? We discussed cost and we discussed net realizable value. Next step is we need to compare. How to compare? Standard is saying that compare the cost and net realizable value for item by item, and you can compare for group of similar inventories also. But standard is saying that don't compare inventory wise like finished goods for work in progress for raw material. You should not compare like that. Okay. And also inventories in a particular operating segment. For suppose we are having a segment in Hyderabad, second segment in Bangalore. We should not treat all inventories in Hyderabad segment are having a group of similar inventories. That is what the standard is saying. Okay, what I'm saying, we need to identify, we need to compare the cost and NRV item by item or group of similar inventories. Okay, we should not compare finished goods to finished goods, raw material to raw material, work in progress to work in progress, or we should not assume inventories located in one segment are having a group of similar items, right? So that is what the standard is saying. After comparison, if for suppose if our NRV is lower than cost, we should measure our inventories to NRV. So whatever the difference between cost and NRV, we charge to profit and loss account, right? That is what the standard is saying. And if we use our raw material in manufacturing of finished goods, okay, if we use our raw material to manufacture a finished goods, if that finished goods is sold at or above cost, in that case raw material can be measured at cost only, even though that raw material NRV is lower than cost of raw material. If finished goods in which our raw material is incorporated is selling not at or above cost, in that case raw material should be measured at replacement cost. That is best NRV, right? And next one is a reversal of write down. So whatever the inventories we have write down to NRV should be reassessed for each subsequent period. On such reassessment, if we notice that conditions that led to write down in the previous year no longer exist or our NRV increased, in that case we should reverse. We should reverse that. And that reversal should be that reversal should not exceed our previous write down. That is what the standard is saying. Clear what I am saying? Our reversal should not exceed previous write down. And after such reversal, our carrying amount of inventory should be cost or NRV, whichever is lower. What the standard is saying. And next one is, if we sell that inventory, we should de-recognize it. See here, we are crediting inventory and debit will go to cost of goods sold. No, if we are not selling, we are using that inventory in our construction project, construction of PPE. In that case, you capitalize to PPE. PPE account debit to inventory accounts. That's it, sir. This is all about Ind AS 2. So let's see you in the next session, right? Bye bye.